How you doing, Cooper?
Good. How are you?
Good, good, good. So my name is Average Dose Crypto. My actual name is Ryan, so you can call me that. I'm moderating the session. I'm a research manager at Mizari. I'm joined by Cooper. He's BD over at Injective Labs. So we're gonna talk it up about some dexes, how to get your first billion in volume. We're gonna touch them on some real world asset stuff. First question I want to ask you. So being Injective, it's a Cosmos chain. If you're starting up a new DEX, right, how do you think about what ecosystem to deploy to, right? Like, what are the considerations you have to make?
Yeah, totally. It's a great question. Again, thanks for, all of you for coming out and listening to this question. But from our perspective, what we're building at Injective is essentially an ecosystem where all different finance-based applications can thrive. And, what does that mean? They essentially can come take a bunch of white labeled modules, such as our Exchange module, our Oracle module, our Bridge module, and build native interoperable kind of financial applications that can leverage existing on-chain liquidity, institutional grade is on-chain liquidity, and seamlessly spin up any application they would like. We believe in kind of our ecosystem. We kind of provide an environment that allows to seamlessly foster those types of things.
Now, Injective's pretty unique. A lot of DEX volumes on crypto are AMMs, but Injective has like an order book. How do you think about the difference between the two? Can they work? Can they synergize with one another? And maybe touch a little bit more upon like why Injective uses an order book.
Yeah, great question. So everybody's familiar, and what kind of got me into crypto was the AMM, and that's the peer to pool model, right? Injective, offers the central limit order book that you would see on the New York Stock Exchange or on Binance or something of that nature, which creates a significantly more capital efficient environment, and allows for market makers with significantly less capital to come on, place orders, utilize things like margin, leverage, more of a traditional finance kind of oriented kind of use case, and offer all different types of novel assets across derivatives, spot, et cetera, to allow applications to be built, as well as kind of different use cases like Helix, which is our kind of primary DApp across the Injective ecosystem, that sees a lot of flow kind of flourish. So I would say kind of when you're assessing different types of how are things built and why do things are built in different manners, right? An AMM essentially is great for long tail assets. It's incredibly capital inefficient. You have to have tons of different, assets sitting in a singular pool. And it's really good at pricing those things. However, if price discovery is occurring somewhere else, like on Binance or on Coinbase, right, you want to create an environment where, capital efficiency is at the forefront, and you can optimize for other features. So that's what we've done on the Injective side of things. And we've kind of, created really, from our opinion, the first fully on-chain central limit order book exchange experience, that's been around for several years, has done over 40 billion, I think, as of today in volume, and a lot of exciting things to come.
Yeah, it's really interesting when you get down to it and like the differences between the two, and especially in terms of price discovery, because sometimes on AMMs they get essentially bad volume.
Right. So, I mean, just to double down on that, right? Let's think about it just from a high level, right? So if an AMM is operating with no understanding of what's happening, where price discovery is occurring, which is almost always happening on Binance in today's world, and, as we're sitting here right now, then, a liquidity provider is always going to suffer impermanent loss because they're going to get picked off in their LP positions, right? And usually even the chain, Injective, right? We've optimized for block times. We have 650 millisecond block times. Some folks are running at minutes, several minutes, et cetera. But if your protocol cannot update to understand how, external information and the asymmetry is occurring between where price discovery is occurring and where liquidity is kind of, being offered on chain, not only is it capital efficient, but you're going to lose money over the long term. And we've seen some of the best teams, try to tackle this problem from an AMM, perspective. However, with latency driving high frequency trading, we think it's probably one of the hardest things to tackle.
Yeah, and then kind of circling back a little bit, Injective's unique in the sense that it is its own layer one.
Right.
Most DEXs, I would say, in crypto are a protocol built on top of another layer. Can you talk to me a little bit about like the differences in where the value is accruing in these situations? Why is it better? Why would it be better for a DEX to be its own chain versus, deploying on, let's say, an Ethereum or a Solana, like its own layer one, something like that?
Great question. So I would say, right, liquidity is super hard to beget, right? One. And thing two is users are incredibly hard to beget, as well as the complexity of having to build your own blockchain, have to offer your own 60 validator, validator set, et cetera. But from our perspective, with that all being the case, I would also say that you get to offer an incredibly customized experience that can be built for a specific use case. And in our case, it's finance.
Yeah, yeah. Speaking of finance, I'd say one of the big trends over the past maybe year and a half has been.
Oh, I think we have a guest.
Welcome, David from Trader Joe. Oh, NFJ. Okay.
Hey,
Oh, LJ.
how are you?
How are you?
Super. Not joining us. Thank you.
Yeah. Why don't you give a little intro about yourself? Quick, one sentence. We've been chopping it up about Injective Labs and different stuff, different dexes. So, yeah, what's going on?
Yeah, so LFJ is the leading DEX in the space, building the centralized finance since 3 years and plus. Market leader on Avalanche since the inception of the DEX and also available on Arbitrum. We have been in the space starting from Humble protocol and then grew our strategy to become builders of decentralized finance products, leading towards the creation of Liquidity Book, which is our core primitive of concentrated liquidity. And thanks to this innovation, we continue to explore and deploy new products that leverage the possibility of for liquidity providers to supply their liquidity in new ways that have been different than how they know it from all other protocols.
Very cool. So where we left off, I was talking about that one of the biggest trends over the past year and a half has been the institutions are coming, like they're actually here. Tether is one of the best business models, right? They do billions in revenue. They have very little employees. How, as a DEX, should you be thinking about institutions and real world assets? Do you want to start with that, David, or Cooper? Did you want?
Well, I mean, I think, right, you brought up a great point. Tether is probably one of the best businesses on earth, right? They've proved, from my perspective, in crypto that asset issuance and bringing assets on chain is here to stay, right? But then the next question, from my perspective, for real world assets is collateral mobility, right? Why would a user use these real world assets? How are they being plugged in, and what's the use case? And from our perspective, we see it as being used as a form of collateral to trade a derivative, right? Right now, if you want to trade a derivative, you go to Binance or you go somewhere on chain and you use USDT. That USDT is sitting at actually Cantor Fitzgerald down the road, and it's earning 5% for Tether, right? And they're minting money, right? What if we could pass through that yield to the user, and now all of a sudden they're making 5% on their real world asset while they're holding the same derivative position, and those are the types of use cases that I'm super interested in. I think it's really the concept of this kind of collateral mobility, interoperability, kind of composability, a lot of buzzwords, but essentially being able to take an asset and transact with it in a much more efficient and innovative way. So that's what I'm excited for.
It's an interesting topic that I am curious to see how it's going to develop in the next years, because it was definitely the most interesting direction that the market was looking at when we were talking 1 year ago about this same topic. We have explored dozens of different stable coins, all with were yield bearing or not on our DEX. Plenty of these alternative solutions to stable coins have been offered over time. And what we are seeing is that the trend of managing the price of a yield-bearing asset is one of the biggest hurdles that there is on liquidity pools in general. But it's definitely something that requires a very efficient protocol. So with our concentrated liquidity solutions, we have studied how these yield-bearing assets, for example, could move up the bean scale to while earning extra yield on the underlying assets. But it's something that I think retail users rather than institutional users are not too aggressive in holding. Most of the idle time for users is usually on standard stable coins, not RWA type of assets, out of laziness, I will say. Education in out on tap idle liquidity is still very much on the growing side, I think.
And that's a good segue to the next thing I wanted to talk about. As we all know, liquidity in crypto is very fickle. It's very hard to find sticky liquidity. How do each of you in your respective organizations find sticky liquidity, retain it? And what is kind of the differentiator in terms of how you go about getting it?
Sticky liquidity requires big investments into education. Being a protocol that is not a fork of other solutions specifically, when a user gets to know how liquidity book is different than other concentrated liquidity solutions, they definitely fall in love into the flexibility and granularity of control that they have over more popular alternatives. But what truly matters then is to continue improving the UX UI on these solutions, because having control over the shape and the range of the liquidity that we wanted to untap with liquidity book also put the user into a slightly higher curve of education that really requires every single step that we can do in making it easier to understand and to manage is better, because what they usually face as tiredness and what could make a liquidity provider stop providing is having to constantly manage their solutions. There are various ALM solutions also in the space that continue to pop up and to offer managed solutions for the users. But that's, I don't think it's the sticky liquidity that is the dream of a DEX, rather hobbyist liquidity providers that continue to provide liquidity over time.
I would agree, because I think in crypto, the word liquidity gets passed around so much. However, what's important, right? It's the flow. Like, liquidity begets users and users beget liquidity. It's the classic chicken and egg problem. But then how do you get users, right? We're going to announce something on Injective, on the Injective Lab side of, our largest retail campaign to date. And to get those users, which quote unquote, beget that liquidity, and those institutions to come on chain, for them to bring their capital, and, in crypto, the cost of capital is probably the most expensive in any other, in any industry in the world. You have to have incredible flow, and incredible flow comes from users that are using your product because you offer a unique product, right? So maybe it's I offer meme coins or leverage on meme coins for the first time, and I'm the only place that can do it, right? That offers, a very interesting product segment to maybe an interested user who can bring, this liquidity and these institutions on chain. So from our perspective, it's offering unique markets. It's partnering with the right institutions that are going to be here for the long while and have aligned visions on what kind of that retail flow looks like. And then it's going out and not incentivizing essentially mercenary capital, but incentivizing organic capital that's going to come back time and time again to use the product, not to use it for the incentives.
Yeah, that last point you brought up about mercenary capital, it's very tricky, right? And kind of circling back to what this panel is about, getting to your first $1 billion in volume. We got about 5 minutes left here. If you were starting a DEX today, what is the one thing you would recommend not to do in terms of your design choices to kind of make sure that the liquidity that you're getting is sticky liquidity and not this mercenary capital?
Yeah, I mean, I can start there. The first thing I wouldn't do is say, hey, I'm going to give some massive, percent of my token supply to these three big names in the market making space and just think everything's going to change and, help itself, and kind of figure itself out. I would really look at it the opposite way. And I would say, from an exchange perspective, how can I offer a unique product that someone is going to use on my platform as opposed to someone else's? And I really feel like in crypto, that what I just said was so simple, but a lot of the founders don't think of it that way. They say, hey, how can I go get the big name, not to name drop a few, but right, you see like in the on-chain space, the Wintermute name everywhere, right? How can I go get the fundraising announcement with the Wintermute name and, give them a huge percent of my token supply? And I think that's the wrong way of thinking about it. I think that all of those folks, I can guarantee you, will come to your protocol, assuming that you can offer a unique product, right? Like, let's look at Pump.fun on Solana, right? I'm sure everybody's begging to be working with those folks because they built an incredibly unique and novel product on chain. So that would be my biggest advice, to kind of understand that mercenary capital is there until the airdrop and then it's gone. We're seeing it time and time again. But I think it'll be very interesting for things like EigenLayer, which we're going to see just this week or next week. Where does the money go post unlock, right? So I think that's kind of, the biggest advice I would give.
100%. Reaching 1 billion volume is a vanity metric, and any vanity metric can be reached very easily by just pumping the wrong numbers. But what truly matters in volume generation is not really the volume displayed on a platform, but it's rather the fees that are generated by this market. So what truly matters in a market is if your LPs are generating enough fees so that the liquidity is self-sustainable, new liquidity providers could actually join because these are productive pools, and the pools are properly aggregated, they are properly split-routed into the necessary path so that every pool possible is as productive as it gets, and not actually using tokens or incentives towards market makers, but towards retail market makers that are the ones that will provide liquidity with their own assets and to focus on the LPs with the highest efficiency of volume versus fee generated, so that the entire platform can become sustainable for all the pairs that are offered and generate proper flow that is healthy compared to just volume on a zero fees pool that it's completely unnecessary, and it's just paid off in other ways by making sure that that pool generates some volume that is just, as we mentioned, vanity.
I mean, you hit the nail on the head there, right? Like a token and token incentives are a means to an end, right? They're supposed to come to an end. They don't last forever. And liquidity providers should be able to earn the rate at scale, that they're hopeful for.
Awesome. So we got about 2 minutes left. So kind of, I want to end with like a quick, maybe 30, 45 second thing about what do you think, or rather, what are you most excited about in the coming, let's say, 6 to 12 months in the DeFi/DEX space?
I'm personally most interested in seeing this kind of concept of real world assets finally coming on chain in a real way. So I think that there's two different groups right now. There's the teams that are building like the actual tokenization platforms. I find those to be the most interesting. And then I find them there to be like the distribution mechanisms. And I would, kind of categorize Injective, right? We're looking to partner and have a lot of exciting partnerships coming out in the coming months with these folks who can tokenize assets on chain. Then the question is okay, I think we're there, right? You see probably 10 protocols that have over $100 million today, a lot approaching $1 billion, right? But I still, to this day, at scale, have not seen a use case such as being able to swap secondaries with instant liquidity, right? Right now, OTC for venture, for private equity, for any of these things, it is $1 trillion industry, right? Crypto and blockchain, and a lot of the, novel AMM solutions that have come out, et cetera, could essentially allow for a perfect environment where, secondaries liquidities becomes instant and it becomes on demand. And that's kind of what I'm most excited and looking forward to, is essentially how can these real world assets that are coming on chain actually be utilized in an innovative and efficient way more long term?
I'm looking forward to the next generation of scalability for liquidity, as we are seeing now the war for transaction per second and higher efficiency models being deployed in the decentralized exchange space. So we are definitely working towards what will be the next stage revolution for even an higher degree of efficiency in this market. So I'm sure that we are going to see this market definitely ramp up to get ready for the next billion users.
Awesome. So that's about it for all today. Last parting words. If someone in the audience wants to reach out to you, what's the best way to do that?
Yeah, I mean, I'll definitely be here right after. Would love to chat with anybody. Our Twitters, LinkedIn, Telegram, you name it. Just come find us and we'll make ourselves available.
Yeah, on X and Telegram, Davidify, always happy to have new conversations.
Awesome. Well, thank you so much, guys. Of course, thank you. Had a blast, but it's time for us to go.
Cheers.